As of January 2026, the Toronto Stock Exchange has lost $427 billion in market capitalization in just 11 weeks. That is not a correction. That is not healthy profit-taking. That is the sound of something breaking. And here is the number that should terrify every Canadian investor right now. The TSX Composite is flashing 3 specific warning signals that have only appeared together twice in the last century. Once in 1929, once in 2008. Both times, what followed was catastrophic. The year was 1929, October specifically. The Toronto Stock Exchange was riding a wave of unprecedented optimism. Mining stocks had tripled in value. Canadian banks were considered indestructible. The phrase on every broker's lips was the same phrase we are hearing today. This time is different. It was not different. Between October and November of 1929, the TSX lost 43% of its value. But here's what the history books often forget to mention. The real devastation came later. By 1932, Canadian stocks had fallen 85% from their peak. Entire fortunes vanished. Retirement savings gone. And now, 97 years later, we are watching the same pattern emerge. Not similar, the same pattern. The same 3 warning signals. The same institutional behavior. The same public complacency. Let me be clear. This is not about predicting doom. This is about recognizing patterns that have repeated throughout financial history with almost mechanical precision. Patterns that, once you understand them, become impossible to ignore. So what are these 3 signals? Why are they appearing now? And what does this mean for your savings, your retirement, and your financial future? That is exactly what we are going to break down today. Because here is what nobody is telling you. The official story says the Canadian economy is resilient. The official story says our banking system is the strongest in the world. Official story says a crash is unlikely. The real data tells a very different story. There are exactly 3 reasons the TSX is flashing these warning signals right now. And they are connected in ways that most financial analysts either do not understand or are unwilling to discuss publicly. The first signal is what economists call the debt saturation threshold. The second is foreign capital flight. And the third, perhaps the most dangerous, is the resource sector divergence. Let us start with debt saturation. According to Statistics Canada, Canadian household debt now stands at 187% of disposable income. Read that number again. 187%. For every dollar Canadians earn after taxes, they owe nearly $2. This is not sustainable. This has never been sustainable in any economy at any point in history. But here is where it gets worse. This ratio has increased 14 percentage points since January 2024 alone. Between March 2024 and December 2025, Canadian households added $291 billion in new debt. Most of that went into real estate. It's real estate that is now declining in value. The Bank of Canada's own Financial System Review, published in November 2025, acknowledged what they called concerning vulnerabilities in household balance sheets. That is central bank language for something very specific. It means the foundation is cracking. Why does household debt matter to the TSX? Because consumer spending drives 70% of the Canadian economy. When households are drowning in debt, they stop spending. When they stop spending, corporate earnings collapse. When corporate earnings collapse, stock prices follow. This brings us to the second signal, foreign capital flight. Between September 2024 and February 2026, foreign investors pulled $68 billion out of Canadian stocks. $68 billion. This is the largest sustained outflow since the 2008 financial crisis, and unlike 2008, there is no global crisis to blame. Foreign investors are not fleeing all markets. They are specifically fleeing Canada. Let me be clear. When sophisticated international capital starts exiting a market, they know something. They have access to information, analysis, and forward-looking data that retail investors simply do not have. When they leave, they are not guessing. They are calculating. A report from the Bank for International Settlements in December 2025 noted that Canada was experiencing, and I quote, asymmetric capital reallocation patterns inconsistent with its fundamental economic indicators. In plain English, money is leaving Canada faster than our economic data would suggest it should. Why? What do these investors see that we do not? The answer lies in the third signal, resource sector divergence. And this is where the real danger becomes impossible to ignore. Canada's economy has always been deeply tied to natural resources. Oil, gas, mining, lumber. These sectors represent approximately 11% of our GDP directly, and influence another 23% through related industries. When resources thrive, Canada thrives. When resources struggle, Canada struggles. Here is the problem. Since July 2025, global commodity prices have risen 18%. Oil is up, natural gas is up, copper, lithium, uranium, all up. Under normal circumstances, the TSX should be soaring. Canadian resource stocks should be leading global markets. They are not. The TSX Energy Index has fallen 11% during the same period that global energy prices rose. This is called divergence, and it is one of the most reliable warning signals in market analysis. When an asset should be rising based on its fundamentals, but instead falls, it means large institutional players are selling into strength. They are using the good news, the rising commodity prices, as cover to exit their positions before something happens. Mark Faber, the economist who predicted the 2008 crash, wrote in his January 2026 Gloom Boom Doom report that, quote, Canadian resource equities are exhibiting classic distribution patterns that historically precede significant market corrections. Now, let us examine how these three signals connect, because individually, each would be concerning. Together, they form what financial historians call a crash constellation. Mechanism 1. Excessive household debt reduces consumer spending. Reduced spending lowers corporate revenues. Lower revenues trigger earnings misses. Earnings misses cause stock sell-offs. This is already happening. Fourth quarter 2025 earnings for TSX-listed companies missed analyst expectations by an average of 9%, the largest miss since the pandemic. Mechanism 2. Foreign capital flight creates selling pressure on Canadian stocks. As stock prices fall, the Canadian dollar weakens. The loonie has dropped from 74 cents US in January 2025 to 68 cents in February 2026. A weaker dollar makes imports more expensive. More expensive imports fuel inflation. Inflation forces the Bank of Canada to maintain higher interest rates. Higher rates increase household debt burdens, and the cycle accelerates. Mechanism 3. Resource sector divergence signals that informed investors expect Canadian-specific problems ahead. These could include regulatory changes, infrastructure constraints, or international trade disruptions. Whatever the cause, the symptom is clear. Smart money is leaving. Each mechanism feeds the others. Debt pressures weaken consumer spending. Weak spending scares foreign investors. Capital flight weakens the currency. Currency weakness strains households. And throughout all of this, resource stocks, our supposed safe haven, are signaling danger. The official story from Canadian financial institutions remains optimistic. In December 2025, the Canadian Imperial Bank of Commerce released a market outlook calling for, quote, modest growth in Canadian equities through 2026. Here is what nobody is telling you. CIBC's own institutional trading desk reduced its Canadian equity exposure by 31% during the same month they released that optimistic report. What banks tell the public and what banks do with their own money are often very different things. This brings us to a case study that every Canadian investor needs to understand. Because what we are seeing now has happened before, not here, but in an economy remarkably similar to ours. The year was 2018. Australia, like Canada. Australia was a resource-dependent economy with a strong banking sector and high levels of household debt. Like Canada, Australia had a housing market that seemed to defy gravity. Like Canada, Australia believed its financial system was uniquely resilient. Between February and December of 2018, the ASX 200, Australia's primary stock index, fell 19%. But that headline number masks the real damage. The Australian banking sector, which, like Canada's, was considered rock solid, lost 32% of its value. Mining stocks fell 28% despite commodity prices remaining relatively stable. Sound familiar? The pattern is identical to what we are seeing in Canada today. Dr. Christopher Joy, Chief Investment Officer at Coolabah Capital and former Reserve Bank of Australia analyst, documented this period extensively. His research, published in the Australian Financial Review, identified what he called the resource curse paradox. Economies built on natural resources develop dependencies that become vulnerabilities. When global conditions shift, these economies cannot adapt quickly enough. Australia's crash in 2018 was preceded by the same three signals now appearing in Canada: debt saturation, foreign capital flight, and resource sector divergence. The pattern took approximately 14 months to fully develop. From the first warning signals to the market bottom, 14 months. If we apply that same timeline to Canada, with the first clear signals appearing in September 2024, Canada's outflow has reached 68 billion Canadian dollars in 17 months. Adjusting for economy size, our capital flight is more severe. And Australia did not face the additional pressure of its largest trading partner, actively restructuring trade relationships. Canada does. Let me be clear. The Australia comparison is not meant to predict that Canada will experience exactly the same outcome. Markets are complex. Many variables differ. But patterns matter. And the pattern emerging in Canada today matches Australia 2018 with uncomfortable precision. According to a working paper from the International Monetary Fund, published in August 2025, economies exhibiting the three-signal pattern we have discussed experience significant market corrections within 12 to 18 months, approximately 73% of the time. 73%. Those are not certainties, but those are not odds any serious investor should ignore. Every market crash follows a predictable sequence. Understanding this sequence is the difference between being caught in the devastation and seeing it coming. Stage 1 is denial. This is where most Canadians are right now. The warning signals are visible, but are explained away. The TSX fell 8% in January, and analysts called it a healthy correction. Foreign capital is leaving, but it is attributed to global portfolio rebalancing. Household debt is extreme, but Canadians have always carried more debt. Denial sounds reasonable. That is what makes it dangerous. Stage 2 is awareness. A growing number of investors begin recognizing the pattern. Selling pressure increases. Volatility spikes. The TSX Volatility Index has risen 43% since November 2025. We are entering this stage now. Stage 3 is panic. This is when the broader public realizes something is wrong. Selling becomes indiscriminate. Prices fall faster than fundamentals would justify. This stage typically lasts 2 to 4 months and produces the largest percentage losses. Stage 4 is capitulation. Investors give up. They sell at any price just to stop the pain. This is the market bottom, the point of maximum pessimism. And, paradoxically, the point of maximum opportunity for those who prepared. Stage 5 is recovery. But here is the critical point. Stage 5 often does not begin for 12 to 24 months after capitulation. For the unprepared, those months are devastating. The entire sequence, from first warning signals to recovery, typically takes 2 to 4 years. We are approximately 18 months into this cycle for Canadian markets. If the pattern holds, the most difficult period is still ahead. Now we need to talk about what this means for you specifically. Your retirement, your savings, your financial security. If you hold Canadian equities in your RRSP, your TFSA, or your pension, you are exposed. The average Canadian retirement portfolio holds 62% domestic equities. When the TSX falls, those portfolios fall. A 30% decline in the TSX, which is within the normal range for a significant correction, would reduce the average Canadian retirement portfolio by approximately $87,000. For those within 10 years of retirement, that is devastating. Let me be clear, this is not about fear. This is about mathematics. A portfolio that loses 30% needs to gain 43% just to return to its previous value. If you are 55 years old and planning to retire at 65, you may not have time to recover. The official advice from most Canadian financial advisors remains unchanged. Stay the course. Do not time the market. Think long term. This advice is not wrong in normal circumstances, but these are not normal circumstances. When 3 specific warning signals that have predicted major crashes appear simultaneously, staying the course is not prudent investing. It is willful blindness. So what should you watch for? Between March 2026 and August 2026, pay attention to these specific indicators. First, watch the Bank of Canada's emergency lending facilities. If usage increases significantly, institutional stress is building. Second, monitor the Canadian dollar against the Swiss franc, not just the US dollar. The franc is considered a flight to quality currency. If the loonie weakens dramatically against the franc, sophisticated money is fleeing. Third, track the spread between Canadian government bonds and corporate bonds. When that spread widens quickly, credit stress is emerging. The real question we must ask ourselves is this: how many warning signals does it take before preparation becomes wisdom rather than paranoia? History is filled with people who saw crashes coming and were dismissed as pessimists until they were proven right. And history is filled with people who trusted official narratives and reassuring words until they lost everything. The 3 signals we have discussed today are not speculation. They are observable, measurable, documented phenomena. They have appeared before major crashes throughout financial history. They are appearing now in Canada. What you do with this information is your choice, but you cannot say you were not told. If you found this analysis valuable, if you want to understand the patterns that drive markets before they become headlines, subscribe to this channel. We are building a community of people who refuse to be caught off guard, who understand that knowledge is the ultimate hedge against uncertainty. The crash warning is flashing. The question is whether you are prepared to see it.